Tired of missing the best entry points? Want to learn how to see big, trade small, but do not know how to actually do it? Today, I am sharing the inverse fair value gap strategy, which perfectly demonstrates this core trading concept. Use larger time frames to see trend direction, smaller time frames to catch precise entry moments, and combine them to design a high-reward trading system with excellent risk-to-reward ratio. What exactly is see big, trade small as a trading classic? Simply put, you use larger time frames to capture the market's main trend, then use smaller time frames to find precise entry and exit points. This is not just theory, it is a quantifiable trading method. Most traders know this principle, but implementing it manually requires deep market understanding and strict discipline, creating a high barrier for many traders. Today we are introducing an automated strategy, the inverse fair value gap strategy, that perfectly demonstrates this concept. The strategy first confirms the main trend using long-period moving averages, seeing big, then captures reversal signals in short-period charts as entry triggers trading small. When the long-period trend is up, we look for oversold bounces to buy on short time frames. When the long-period trend is down, we look to sell after excessive rebounds. This multi-timeframe approach lets us both follow the power of larger trends and enter precisely at optimal moments for better risk-to-reward ratios. This strategy's core logic showcases a refined multi-timeframe trading approach. The key indicator, IFVG, fair value gap, represents price gaps in the market. Unlike traditional three-candle IFVGs, this strategy focuses on two-candle gaps for the fast-moving crypto market. In this strategy, an IFVG forms when the current candle's low is higher than the previous candle's high, upward gap, or when the current candle's high is lower than the previous candle's low, downward gap, creating a price disconnection area. IFVG, the inverted fair value gap, extends the traditional IFVG concept. While traditional IFVGs focus on price filling the gap area, IFVG focuses on what happens after price breaks through these IFVG zones and continues trending, like all market extremes that eventually reverse. We use excessive counter moves to find higher probability entries. Specifically, the IFVG strategy core logic works like this. After an IFVG forms, we wait for price to break through the IFVG boundary high or low. Once the breakout happens, instead of trading in the breakout direction, we wait for price to reverse and look for entries aligned with the main trend. In uptrends, when price breaks below the IFVG zone and continues dropping, we wait to buy when price breaks below the IFVG low point, essentially buying the dip after an excessive drop. In downtrends, we wait for price to rally and break above the IFVG high point to go short, selling after an excessive bounce. The strategy uses dual moving averages for larger timeframe trend filtering to ensure trade direction aligns with the main trend. Finally, it incorporates dynamic risk management, initial fixed stop loss, and take profit thresholds create a consistent risk-to-reward ratio. When profit reaches half the take profit level, ATR-based trailing stops activate to protect profits while giving trends room to develop. This fast-in, fast-out approach with high reward ratios embodies the essence of multi-timeframe scalping. The strategy parameters are carefully adjusted for fast trading needs. For risk management, stop loss is set at 0.5%, meaning positions automatically close if price moves against you by 0.5%. Take profit is set at 1.5%, allowing you to exit profitably when price moves in your favor by this amount. This creates an excellent 1-to-3 risk-to-reward ratio, risking 0.5% for potential 1.5% gains. This conservative setup is perfect for high-frequency trading environments, providing enough profit potential while strictly controlling per-trade risk and reducing market noise impact. For trend confirmation, the strategy uses 50-period and 200-period simple moving averages. The 50-period SMA serves as a short-term trend indicator that quickly responds to price changes, while the 200-period SMA provides stable, long-term trend direction confirmation. For dynamic risk management, the strategy uses 14-period ATR average, true range to measure market volatility, and provide dynamic adjustment references for the trailing stop system. ATR automatically adjusts stop-loss distances based on actual market volatility, protecting profits while giving price normal breathing room. The strategy also sets a default trading quantity of 10 units to ensure appropriate position sizing for each trade. These parameters can be adjusted based on different market conditions and personal risk preferences. The indicator definition section mainly covers IFVG and IFVG detection logic. First is the IFVG detection function, which identifies fair value gap areas by comparing price relationships between adjacent candles. The function not only detects IFVG signals but also returns the high and low positions of the IFVG, providing precise price references for subsequent IFVG calculations. By observing candles from 3 periods ago, the system confirms IFVG signals when prices show clear upward, or downward gaps, marking the signal points and recording key price levels. Next is the IFVG detection logic. After detecting an FVG, the system continuously monitors price breakouts of the FVG zone, paying special attention to candle patterns after breakouts. Once price breaks through an FVG zone boundary and forms a signal confirming trend continuation, such as a bullish candle breaking above the FVG upper boundary, or a bearish candle breaking below the FVG lower boundary, the system records this IFVG signal and saves key high and low positions for future signal determination. Trend confirmation logic is based on the previously defined moving averages. An uptrend is confirmed when the short-term SMA is above the long-term SMA, and vice versa for downtrends. This is the core of trend confirmation, ensuring our IFVG trading signals only execute in favorable trend directions. The signal generation logic perfectly demonstrates this strategy's reversal core concept. Long signals need three conditions. First, an IFVG signal must appear, indicating price trend extension. Second, the current closing price must be below the IFVG low point. And third, the market must be in an uptrend, confirming the larger timeframe trend. In simple terms, in uptrends, when price breaks downward through an FVG zone, we do not chase the drop. Instead, we wait for price to continue falling and break below our recorded IFVG low point before going long. This lets us enter at better prices while using the main trend's power for higher reward ratios. Short signals work exactly opposite, requiring an IFVG signal, while current price sits above the IFVG high point, with the market in a downtrend, also ensuring no current position exists. This means in downtrends, when price breaks through an FVG and moves upward, breaking above our recorded IFVG high point, we use this high point in the bounce to enter a short position. The advantage of this thinking is, we always enter at points of excessive reaction, reducing the risk of chasing short-term moves, and instead follow true rationality and trends in our trading. The strategy execution section contains the complete trading operation process. When long conditions are met, and there is no current position, the system immediately opens a long position, setting an initial stop loss, 0.5% below current price and profit target 1.5% above current price, reflecting the strategy's high reward ratio design. Short trades follow the same principle, opening in the opposite direction with corresponding risk controls. The most valuable part of the strategy is the dynamic trailing stop system, key to achieving flexible trading. The system sets a profit threshold half of the take profit target, which is 0.75%. When a position's profit exceeds this threshold, the stop-loss point automatically moves in the favorable direction. Specifically, for long trades, the stop-loss moves up to either the entry price plus 0.75% profit protection, or the current price minus 2 times ATR, whichever is higher. This both protects earned profits and gives price room for normal fluctuations, preventing premature stop-outs due to market noise. Short trade trailing stops work on the same principle, just in the opposite direction. This design is perfect for this strategy's trading rhythm, as the strategy itself uses excessive counter moves, and dynamic stops can lock in profits while giving the main trend enough room to develop, maximizing the profit potential of counter-trend entries. The strategy displays several key elements on the chart, visually showing the time frame trading logic. First are the IFVG key levels shown as red cross markers that accurately indicate short time frame signal positions. When you see these markers on the chart, you should check if the longer time frame trend conditions are also met. Second are two moving average lines, the blue 50-period short-term SMA and the orange 200-period long-term SMA. The relative position of these lines visually shows the longer time frame main trend direction. Short-term line above long-term line indicates an uptrend, and vice versa. The entire visualization design is clean and clear, combining short time frame price structure with longer time frame trend environment to help you understand the strategy's status in real time. The red cross markers are especially important as they highlight the key IFVG signal price levels, which are crucial reference points for waiting for counter moves. This strategy shows unique advantages in different market environments and is an excellent example of applying the see big, trade small approach. It works best in trending markets, perfectly demonstrating multi-timeframe trading principles. In bull markets, the strategy uses longer timeframe trend confirmation to capture technical pullbacks within uptrends. When the overall market trends up, price drops below FVG zones are usually short-term overreactions, and the subsequent rebounds provide high reward ratio, quick profit opportunities. The strategy's longer timeframe trend filtering ensures you only enter positions in favorable environments, while shorter timeframe IFVG signals provide precise entry points. This is the core value of timeframe analysis. In bear markets, the strategy's short functionality equally demonstrates timeframe coordination advantages. After confirming a downtrend on longer timeframes, when price shows a technical rebound and breaks above the IFVG high, it often indicates excessive bouncing with continued downside ahead. The strategy then generates short signals, helping you profit quickly in downtrends. As a fast-line scalping strategy, it is especially suitable for minute-level charts for intraday trading, using long-short timeframe coordination to achieve high reward ratio trades. But be careful in ranging markets. Lack of clear longer timeframe trend direction may cause trend determination failures, and frequent trend changes with many price gaps may generate too many trading signals. In such cases, it is advisable to pause using the strategy or add extra trend strength filtering conditions. The strategy already has a complete risk management system including automatic stop loss and dynamic profit protection, perfectly matching the rhythm of time frame trading. Some advanced usage tips include using this strategy more aggressively for instruments with clear longer time frame trends, and adding extra confirmation conditions like volume for instruments prone to false breakouts. Remember, time frame analysis requires patience to wait for perfect alignment of long and short time frame signals. Use this strategy during clearly trending sessions and avoid operating during periods with ambiguous trends. Evaluating this strategy from a time frame analysis perspective, it shows excellent performance across multiple dimensions. In terms of completeness, it performs brilliantly, perfectly implementing the time frame coordination trading concept, from longer time frame trend confirmation to shorter time frame signal identification and risk control. It includes a complete system with trend filtering, entry triggers, fixed stop losses, target take profits, and dynamic trailing stops that can adapt to changing market conditions. Risk management is this time frame strategy's biggest highlight, with a 1 to 3 basic risk to reward ratio demonstrating high reward ratio design principles. The ATR-based dynamic trailing stop mechanism both protects profits and gives trends room to develop. The automatic stop loss adjustment after profits is especially important, perfectly matching time frame trading rhythm, which is crucial for short-term trading. For market adaptability, the strategy uses longer time frame trend filtering to effectively confirm trends, while shorter time frame signals provide precise entry points. This perfect time frame combination reduces the risk of counter-trend operations, showcasing the core advantages of time frame coordination. However, it may react somewhat slowly at rapidly changing market turning points. The moving averages, while stable, may lag during early trend reversals. Note that strict entry conditions result in fewer trading opportunities, essentially functioning more like a spike-catching strategy. It is moderately difficult to understand, requiring some trading background to grasp the time frame concept and fair value gap principles, but the logic is clear enough for intermediate-level traders to master. For innovation, combining traditional IFVG concepts with time frame strategy is an excellent innovation, with practical value in real trading, especially the improved detection mechanism enhancing signal reliability. It is highly practical with reasonable design and easy operation, with plenty of parameter adjustment space, particularly suitable for investors wanting to learn time frame trading techniques. The comprehensive risk management framework gives the strategy strong survival capabilities in high-frequency trading environments. Overall, this is an excellent example of time frame analysis practice, especially suitable for investors who have mastered basic trading skills and want to learn time frame analysis to achieve high reward ratios in short-term trading. I hope this strategy explanation helps you better understand and practice time frame trading techniques. If interested, feel free to analyze and backtest the strategy code for free on Inventor platform. See you next time.